Welcome back to the deep dive. Okay, let's unpack this. Today we're taking a closer look at Treasury Notes. Now, I know for many of you tracking the markets, T-notes might seem, well, a bit dry maybe, or just part of the background noise. But our mission today is really to keep it simple and show you how these things are actually incredibly important. They're like these unseen threads pulling on stuff in your life. You know, things like mortgage rates, even the overall economy. You hear about the 10-year Treasury yield all the time, right? And what's really going on there?
That's exactly right. And what's fascinating here is people call them the bedrock of global finance. You hear unseen foundation, too. And yet, understanding how they actually work and just how far their influence reaches, well, it can still feel a bit murky sometimes. So getting a handle on Treasury notes or T-notes, it isn't just, ticking a financial literacy box. It's really about getting this crucial lens to see what the economy is actually doing. They're much more than just government IOUs.
Okay, so if they're that big a deal, let's nail down the basics. Keep it simple. What exactly is a Treasury note?
Right. In the simplest terms, yeah, it's an IOU from the U.S. government. You're lending the government money.
And they promise to pay you back.
Precisely. They are U.S. government bonds, but specifically the ones that mature somewhere between 2 and 10 years. If it's shorter, it's a T-bill. Longer, it's a T-bond. But that 2 to 10-year note range, that's kind of the sweet spot where a lot of the action happens.
Got it. And how does it work for me, the investor? If I buy one, what happens?
Okay, so you get interest payments. Regular ones, usually every 6 months, for the whole time you hold the note. And then right at the end, when it matures, you get your original investment back. The face value is designed to be very predictable.
Right. Predictable income.
Ah.
So let's use that example to make it super clear. Say you buy a $1,000 T-note, maybe a 5-year one, and it has a 4% coupon rate. That 4% is the interest the government promises on that $1,000 each year.
Exactly. That's fixed based on the face value.
So what that means for you is you'd get $20 every 6 months, $40 a year, right, for 5 years. And then, boom, at the end of the 5 years, you get your original $1,000 back. It seems pretty straightforward.
It really is. And if we zoom out a bit, think bigger picture. The government issues these because, well, it needs to borrow money, lots of it, to fund everything it does, defense, roads, you name it. And the reason everyone from, regular folks to giant banks considers them so safe, it's that phrase, backed by the full faith and credit of the U.S. government. So that's not just talk. It's a guarantee, basically. The strongest guarantee you can really get in finance, which is why they're seen as almost risk-free.
That full faith and credit definitely sounds solid. But, just playing devil's advocate for a second, has that ever really been tested? I mean, really tested? Or are they genuinely considered untouchable?
That's a fair question. And it gets right to the heart of why they have this status. Look, historically, the U.S. government has never defaulted on its Treasury debt. Never. Sure, we've seen political fights, drama around the debt ceiling and things like that. But the actual payments on T-bills, T-notes, T-bonds, they've always been made.
Yeah.
Always. And it's that perfect track record that makes them the global benchmark for a risk-free asset. It's like the foundation stone everything else is built on.
Okay, so that deep trust, plus the fact you can buy and sell them easily, that liquidity.
Yeah.
That's why the big players, hedge funds, banks, even the Fed, aren't just using T-notes, they're kind of obsessed with them, right? Because they know shifts in T-notes echo out into, well, pretty much everything else in the markets, like hidden strings being pulled.
Absolutely. Their influence is just pervasive. It spreads everywhere, which is why the pros watch them like hawks.
And among all the T-notes, the 10-year Treasury note, that's the famous one, isn't it? The heavyweight champ everyone quotes. It's this key benchmark. And you mentioned it affects rates we see like mortgages, student loans. How does that connection work? Why the 10-year?
Yeah, the 10-year is kind of the bellwether. It's often seen as reflecting longer-term expectations about economic growth and inflation. It's long enough to capture broader trends, but not so long that it's completely detached from current conditions.
Yeah.
So when a bank decides what rate to offer you on, say, a 30-year mortgage, they'll look at the 10-year Treasury yield as a starting point. That's the baseline risk-free return they could get. Then they add on their own bit for risk, profit, admin costs, all that. So yeah, it really acts like an anchor for lots of other long-term rates.
Okay, that makes sense. It's the anchor. Now, another thing you hear constantly is T-notes being a safe haven. What does that actually look like in practice when investors do this flight to safety?
Right, safe haven.
Yeah.
It means when things feel shaky. Maybe the stock market's plunging, or there's some big geopolitical crisis, or just general worry about a recession. Investors get nervous. They don't just stand still. They actively look for safety. And where do they often go? Straight to U.S. Treasury notes, because of that government backing we talked about. That's the flight.
And when everyone rushes to buy them, the
That's
price
how
goes
going.
up, right?
Exactly. Demand surges, price goes up. And here's the crucial bit for bonds. When the price goes up, the yield for anyone buying it now actually goes down. It's an inverse relationship.
Okay. So falling T-note yields can actually be a sign of fear.
Yeah.
Investors are piling into safety, pushing prices up and yields down.
Precisely. It's a really clear signal. When you see yields dropping sharply because of this kind of buying, it tells you there's significant fear or caution spreading through the market. So that whole safe haven thing, it's not just, a market quirk. It's a real-time barometer of investor confidence or lack of it.
Okay, so pros aren't just holding these for safety. They're using them, like decoding signals for the future, managing their money. You mentioned signals, and one big one is yield curve analysis. It sounds technical, but you're saying it's basically comparing yields, like a short-term one, say a 2-year T-note versus the 10-year. What does that comparison tell us?
Yeah, this is where it gets really interesting, almost like looking into a crystal ball sometimes. Normally, you'd expect to get paid more interest for lending your money for longer, right? So typically, the 10-year yield should be higher than the 2-year yield. That gives you an upward sloping yield curve. That's the normal state of affairs. More time, more risk, more reward.
Okay, normal is upward sloping. So the aha moment is when it flips.
Exactly. That's the inversion. When the yield on a shorter term note, like the 2-year, actually climbs higher than the 10-year yield, that's an inverted yield curve. And the reason it gets so much attention is that, historically, it's been a surprisingly reliable predictor of recessions coming down the road. Not always, not perfectly, but often enough that people take it very, very seriously. It inverted before the '08 crisis, before the dot-com bust. Its track record is pretty compelling.
Wow. Just the difference between two bond yields having that kind of predictive power. So how do the big players like pension funds use that kind of insight, or just T-notes generally?
Well, beyond just looking for recession signals, it's core to their portfolio strategy. Think about huge funds managing money for pensions or insurance companies. Even just a standard balanced portfolio, maybe that 60% stocks, 40% bonds idea. They use T-notes strategically for balance. When stocks seem risky or the market's choppy, they'll often increase their allocation to T-notes.
For that stability and income we talked about.
Exactly that. You get the steady income, plus they tend to hold their value or even go up when stocks are falling. They act as a buffer, a cushion. It helps reduce the overall swings, the volatility in the portfolio, especially critical if you have long-term obligations like paying pensions for decades.
So we've got foundation, benchmark, safe haven, recession signal, portfolio balancer. What about the really active players? Hedge funds, banks, are they doing even more complex stuff?
Oh, absolutely. It goes further. Hedge funds, for example, they don't just buy and hold. They actively trade T-note futures. They're essentially betting on which way interest rates will go. If they think rates are heading up, they'll short futures. If they think rates will fall, they'll go long. It's pure speculation on rate movements. Banks use them heavily, too, often for hedging. Imagine a bank holding billions in fixed-rate mortgages. If interest rates rise sharply, the value of those mortgages could fall. So they might use T-note futures or other Treasury instruments to offset that specific interest rate risk. It's a fundamental risk management tool across the whole system.
Okay, pulling back again, all these uses, all these signals, what are the key takeaways for you listening at home, just trying to understand the economy? What macro signals should you watch from T-notes?
It really does give you a powerful lens. Keep it simple. Generally, if you see T-note yields rising persistently, it means borrowing costs are going up. For companies, for individuals, that can often put pressure on stocks, as higher borrowing costs can squeeze profits and make future growth less valuable. Conversely, if you see T-note yields falling, it suggests borrowing is getting cheaper. That can often be a tailwind for stocks, for real estate, makes money easier to access. So just watching the direction of something like the 10-year yields gives you a real clue about the market's thinking on inflation, growth, and where rates might be headed.
Right.
So let's tie this all together. Treasury notes. They really are that bedrock, aren't they? Professionals use them for safety, yes, but also for income, and crucially as this sort of measuring stick, this indicator for the economy's direction. And hopefully, as we walk through it, understanding the basics doesn't have to feel overwhelming. It's about seeing their central role.
Absolutely. And maybe here's a final thought, something to really chew on. Given how absolute fundamental they are, the ultimate safe asset, the benchmark for everything else, just imagine what would happen if T-notes somehow lost that status. What if, for some reason, the world stopped seeing them as the ultimate risk-free investment? Think about the ripples, the chaos, really, that could cause. For global markets, for economies, for just everyday financial life, it really underlines how critical these seemingly simple bits of government debt actually are.
That is a powerful thought, the reminder of how interconnected it all is. Well, thank you for joining us on this deep dive into Treasury Notes. We hope you feel you've got a clearer picture now, maybe feel a bit more confident decoding those headlines about yields. Keep exploring, keep learning. Until next time.